Hi everyone, today we're going to be doing lesson 2 of Unit C. This lesson focuses on financial decisions, including compound interest. Our first question asks us to explain the difference between simple and compound interest. To do this, let's look at some examples of simple and compound interest. An example of simple interest would be that maybe you borrow $100 from a friend and you offer to pay 5% interest. The calculation for how much you would owe your friend would be 0.05, which is 5% written as a decimal, times $100. This would give you $5. So at the end of the period that you borrowed the money from your friend, you would give them $105 in total. To consider compound interest, let's imagine that you put $1,000 in a savings account that provides 0.25% interest that's compounded monthly. Let's take a look at what this would look like over a series of months. As you can see, you're going to start with $1,000 as your beginning balance, and then you're going to earn $2.50 interest on that for the first month. That means at the end of that month, you're going to have $1,002.50. Each month, you're going to get interest on the interest that you earned in the previous month, which means that, as you can see, the amount of interest that you're earning each month is going to increase slightly. That's going to have an impact on your end balance each month, and again, you're going to see an increase from month to month. By the end, after a year or 12 months, you are going to have $30 extra in your account from when you began. This situation where you're going to get interest on interest that you've previously earned is referred to as compounding interest. So to summarize, the main difference between finding simple and compound interest can be shown on this graph. Simple interest is going to mean that you're going to get a set amount of money every year for however many years the interest is calculated. That means that that amount would be repeatedly added to your original principal or original amount that you invested. Where with compound interest, the amount of money that you're going to get as interest is going to increase more and more each year. This means that your account balance is going to increase in a non-linear way. It's going to increase significantly faster than it would if you were only getting simple interest. Question 2 asks us to identify the differences between appreciation and depreciation. Let's look at an example of appreciation first. When the value of something appreciates, it means that it begins at a certain amount and then over time becomes worth more than it was to start. So for instance, when we buy a house, when we first buy the house, we might pay, say, $500,000 for it. But over a number of years, as the market changes and that house becomes worth more money, we might eventually sell that house for $750,000. This is the appreciation of the value of the house. Depreciation is the opposite. It means that the value of something is decreasing over time. So if, for instance, we buy a car, and today we pay $30,000 for our new car, over time, as we drive that car, its value decreases. So perhaps in 5 years, when we go to sell that car, we might only be able to sell it for $20,000. This reflects the depreciation of the car's value over time. Question number 3 asks, if we were borrowing money to buy a car, would we rather have a bigger interest rate or a smaller interest rate, and why? When we borrow money, we owe the interest, so it's additional money that we have to pay. So if we thought about buying a new car and we were borrowing the money to do so, we would want there to be a small interest rate so that we would have to pay less money overall for the car. Question number 4 asks us to consider, if we had $1,000 to invest, whether we would rather have a bigger interest rate or a smaller interest rate, and why. If we're investing money, then this means we're going to get the interest that we earn. So we would want to have a bigger interest rate so that we would get more money in the end. Question 5 asks us to name some situations in which appreciation and depreciation occur in real life. We've already talked about a couple of examples. An example of appreciation would be the cost of a house. An example of depreciation would be the value of a car. Many electronics would also be examples of depreciation. So for instance, the value of a laptop or the value of your phone. Each of these are going to decrease over time. Some other examples of some items that would appreciate might be the value of a coin collection or perhaps the value of an investment. Good luck making good financial decisions.